Yeah, it's kind of a miss. I still don't think it's enough to shock the BOJ into action, but it is worrying. Probably because the business investment still is not looking so strong, and I think really actually the BOJ is most worried about exports. In addition to the wage picture, I think the tone of the export recovery is just so slow, and exports were down 2.3% on the month in real terms in January. So if this type of data continues, we may see them easing a little bit earlier than expected.
Data from Japan has been soft for some time. We think this plays very much into yen weakness going forward, a position that's very lightly held in the market at the moment. So that combined with the rebound that we're getting in the US data, we think argues very much for dollar yen moving higher from a trade that's not so much a higher beta trade as some of the others out there.
I think the market clearly is concerned. I think, wherever you talk to investors, there is anecdotal prevalence of the carry trade in China because the interest rate is so much higher onshore than the funding cost offshore. So we are probably seeing a little bit of that coming off. And I think the RMB weakening a couple of weeks ago was probably due to the central bank not intervening as much as they used to. If you look at the key constraints on credit expansion, inflation, LDR, RRR, those suggest room for easing. But the key question is, when will that happen? And, for the equity market, one day could be, like eons. But we do think sometime around the mid-year, you'll see some easing happening. But I think first half clearly will not be an easy time for equity investors in the MSCI China.
Not right now, I would say. U.S. earnings are about 30% above where they were in 2007. Stock prices about 20% above where they were. We see a lot of favorable trends in the U.S. from our booming energy supplies to really productivity that are going to drive the market, we think, higher. And I think that there are fewer risks because households have deleveraged, and we see a recovery, post this weather crisis, which has put odd, unusual situations in our data. We really like the way the U.S. is shaping up.
I would say a bit more expensive than the last comment, but not alarming yet. And I think that bull markets end with bangs, not with whimpers. So I don't think it's going to creep up to 19 or 20 times and just fade away. Something will happen, and it'll blow it up at that point. As long as there's no military action in the Ukraine, I think we're safe from the Ukraine for the time being. But something else could come along. I guess there's a lot of nervousness about China's growth, or not growth as much as we'd like, or something of that sort.